This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. So with earnings season now winding down and we're heading into the end of the year, I wanted to find some cheap, strong buy stocks. These are the Zacks #1 ranks. That's the highest of the rank that we have. We've seen a lot of earnings estimate revisions thanks to earnings season. So now is the time to look and see who beat, who maybe raised, and who is still cheap. Or is anyone cheap? I don't know. But I wanted to run the screen. We haven't talked about the top ranked stocks in a while, and certainly ones, that are dirt cheap. So I ran the premium screen that you do have to have Zacks Premium to run on our screening tools, and it's called Undervalued Zacks #1 Stocks. Well, that seems pretty obvious, right? That's exactly what we want. This is an easy screen. It's already pre-made, but what is in this screen? So it does look for average volume over 100,000 so that we're not getting stocks that nobody is really caring about or noticing. The last close for the share has to be over $5 again, so that we don't get some kind of micro cap stock that nobody's ever heard of. A PE has to be under 20, which some of our screens for value do use the 20 because it's a little more generous. And since we're already, looking for the #1 rank, that's already going to keep it at a small number. So we don't want to get 0 necessarily. So the PE is under 20, and the price to sales ratio, that's included in this screen as well, and that's under 1, which it always is. We always look for price to sales ratio under 1. And why do we use price to sales ratio to find cheapness? Well, that is, as I always say, if you have a price to sales ratio of 0.7, for instance, that means we're paying 70 cents for every dollar of the sales. So we're getting them cheaper than what the company is generating. And that is a bargain. That is on sale, so to speak. And that's what we want. So it's hard to get a price to sales ratio under 1. Also, some value investors like to use price to sales ratio because you can't really mess around with it as much as you can with the PE ratio. And what I mean by mess around with is, earnings, you could maybe, bring in some big order at the end or cut some costs to get those earnings up. You might buy some more shares, do a share buyback program, and that will make the E look a little bit better. But price to sales is basically what it is. Your sales are your sales. It's, you can't really fudge that. You're either selling the product or you're not. So that's why a lot of people like to use price to sales for the value side, because it might be a little more consistent, so to speak. So if that's cheap, then it really is cheap. Let's put it that way. So this screen also obviously includes the Zacks #1 rank, which is the strong buy. And normally there's anywhere from 215 to maybe at the max 250 companies that might have that rank. So this is a small universe. And I ran the screen and I got 15 stocks. And it was a pretty diverse group, actually. And I picked stocks out of it, 5 stocks to talk about, that are also pretty diverse. So we weren't overwhelmed with only the home builders or retailers, like we've seen a lot of those have been cheap. No, we got quite a mix, and that's a good thing. That's a good thing going into 2025, because that means there is still quite a few cheap stocks where the earnings estimates are on the rise. That's what the #1 rank means. It means the analysts have changed their earnings estimate and they've raised it in, the recent weeks, basically. And in some cases, maybe even just the last week, they might have raised it. So that is telling us something good is going on at the company. But I also wanted to throw a little bit of a wrench into this screen by also asking, these are going to be cheap stocks. They're going to have the number one rank, but are they really values or are they traps? And we've talked about the value versus trap thing many times on the show, but I also wanted to look at that aspect of it. So the analysts are raising estimates, but that doesn't mean year over year earnings growth is there. It doesn't mean next year is looking better than this year. It just means the analysts are finding something better is going on and they're raising those estimates, but it might not be as great next year as what we think. They might have been too conservative. And so they're getting more in line with what the company said, but it doesn't necessarily mean it is a true, really great value stock. So let's dive right into the 5 stocks that I picked. And like I said, they're in all different kind of industries. So the first one out the gate is a home builder, and it's Dreamfinder Homes, ticker D as in David, F as in Frank, H as in home. Dreamfinders Homes. And they were founded in Jacksonville, Florida in 2008. They do build in numerous states. And these are basically all of the kind of hot states for the home builders right now. So Florida, obviously, as they're headquartered there, Texas, North Carolina, South Carolina, Georgia, Colorado, Virginia, Maryland, and Tennessee. So those are, as I said, pretty hot states. Earnings expected to be up 20% this year, but only up 5.5% for next year. So kind of staying flat, basically, so far. But looking for 335 in 2024, 337 in 2025. 2 estimates are higher in the last 30 days for Dreamfinders. So that is why you got the Zacks number one rank, because nobody is cutting, they are raising, and they're in agreement. So that's where we get the Zacks number one rank. I did have to look because I didn't write down here. Was it just in the last 30 days or last 7 days? No, it is the last 30 days for those estimates to be revised higher. So how cheap is it? It's got a PE of 8.1. We know the home builders have been pretty cheap. This is another cheap one. PEG of 0.66. Kind of like to look at that. Oh, no. Yeah, that's a PEG. The price to sales ratio is just under 1 at 0.9. Sorry, the PEG, the price to sales ratio is 0.66. Getting a little confused on this one for some reason. I want to get it right. No, the PEG is 0.66. What is the price to sales ratio? It's 0.64. So they're basically the same. PEG is 0.6, price to sales is 0.6. Both of those are cheap, by the way. We didn't screen for PEG, which is the growth plus the value. But I do like to look at it every once in a while. And in this case, it is also showing that it has both value and growth. So everything is looking pretty good for Dreamfinders Homes. Year to date, however, it's down 18%. Not many of the home builders are actually down on the year. So something might be going on there, or, the analysts are just getting a little nervous. Maybe it's the markets they're in. Florida inventory is rising as well as Texas now. So you're having, maybe some inventory issues going forward there, where then the home builders have to, provide incentives to try to move inventory. I'm not sure. I would have to go listen in on this conference call, which I do suggest everyone does on any of these stocks. But it is somewhat unusual to see one of the home builders down that much this year, because while things aren't like a couple of years ago, many of the home builders still do have pricing power. Their gross margins are elevated, and they have been performing pretty well this year still, the stock. So is this a true deal? Well, is this a value or a trap? The earnings are only expected to be up 0.5% for next year. So that is where I feel that there might be a little bit of a warning sign here that we aren't going to see any growth really for next year. So this does have some trappiness to it. I would go investigate before diving in on this one. It's Dreamfinder Homes, ticker DFH. Okay, the next stock is one we've talked about a bunch because it's still got the number one rank. It has big growth and it's cheap. Tenet Healthcare. They are ticker T as in Tom, H as in Harry, C. THC. And if you recall, they do ambulatory surgery centers, surgical hospitals, outpatient care and facilities, services on the healthcare side. So this has been hot. PE 13.5, price to sales ratio 0.7. Those are all cheap, but we screened for that, so it should be cheap. 2024 earnings still looking fantastic, up 63% to 1138. But 2025 so far up only 1.7% to 1158. And one is higher. One analyst has raised their estimates for both 2024 and 2025 in the last week. That's why we got the number one still. And so there, at least one analyst is getting bullish. Now, because we're at the end of the year, we are looking more towards, 2025 now, not caring so much about 2024. So the analysts are being a little bit cautious about 2025 unless the company itself has come out and said, it's going to be fantastic. We're raising or we're initiating guidance for 2025 at this, crazy high level. And, it's rah, rah, rah. It's looking super good. But it's still a little early for some of these companies to be giving guidance for 2025. It all depends on the company and what they've done historically. But this case, even if Tenet has given guidance, we are still seeing only earnings up 1.7%. Stock is still cheap, though, so you don't have to be that concerned about valuations. But if you're looking for both the value with the growth for next year, you're not really getting it here. So maybe wait for a pullback. You get the stock even cheaper, but it has a little bit of the trappiness here. Not too bad, kind of like Dreamfinders. It's not crazy growth for next year, but it's not a decline either. So, it's one of those where keep an eye on it, keep it on your watch list. Tenet Healthcare, ticker THC. Then we're going to switch over to restaurants. A lot has been going on in the restaurant industry. Some big winners, some big losers, but this one's got the Zacks number one rank. I used to follow it many years ago and then kind of dropped off my list, off my radar. And I've always wanted to go to one, but the last time I was in California, I think I looked it up and there wasn't one near me that I could even Uber to easily. So I didn't go. Now I'm regretting that. I guess I got to go back out to one state they're in and find one. And the restaurant chain is El Pollo Loco. Yes, I'm saying that wrong. I'm terrible on the names, as you know. So I'm just going to call it Loco. And the ticker is LOCO, LOCO. And they are famous for their fire grilling fresh citrus marinated chicken. They do advertise themselves as a healthy alternative because it's not fried. And this kind of chicken and restaurant chain, both the healthy plus this type of grilled chicken is big in the industry right now and with consumers. So what is going on with them? They are in 7 states, and this is why I have not been able to get to one because they're not in Illinois. And including California, they're in Arizona, Colorado, Nevada, Texas, Utah, and Louisiana. They are celebrating their 50th anniversary, however, and now they're looking to expand into some areas they haven't been before. So the company said they're looking at El Paso, Boise, Kansas City, and Seattle area in 2025. So, and they're remodeling their restaurants. They just launched a new rendering of what the new restaurants are going to look like to get into the modern era. So that could be important too. But I'm kind of liking like what I'm hearing from El Pollo Loco. And I don't know, Kansas City would be the closest one for me. Maybe I'll try to take a trip to Kansas City once it opens to try the chicken finally. PE 15.8, so a little higher than some of the others we've talked about, and just over 15, but that's still pretty cheap. Price to sales ratio of 0.8. What's going on with earnings? So 2024 expected to be up 16.9%, 2025 12.9%, and that looks like 83 cents for 2024 and 93 cents for 2025. So I'm liking that. That's nice double-digit earnings growth. Year to date, the shares are up 33%. They are off their lows. And so they're not as cheap as what they used to be. Market cap of just 361 million. So this is a small cap stock. And if the small caps finally do have a massive run, we're all kind of waiting. We've had fits and starts. But when we do get one, then a stock like this will also be a part of that because it does lift all boats. So that's El Pollo Loco. Now I'm just hungry after talking about it. Ticker LOCO. And I forgot to mention what Tenet Healthcare has done year to date. That stock is actually up 99% year to date and still really cheap. So keep that in mind if you're considering Tenet Healthcare. And when I said maybe wait for a pullback, you might want to wait for one on that one. Okay, moving on to number 4 is Greenbrier. I haven't talked about this stock in a while. Ticker G as in George, B as in boy, X, GBX. And they are the freight rail car manufacturer and freight services. They do a lot of leasing, and they have been building their leasing business to try to add some stability because the leasing side of things is more stable. It doesn't have huge cycles like the manufacturing does. And that's when I've always talked about Greenbrier, even going back to the Great Recession. You will have periods where nobody needs the new rail cars, or they have like a new style of rail car with new regulations, government mandated regulations. So everybody needs new rail cars. Everybody puts in the orders, they get them, then they don't need anything for a couple of years. So you had these big swings up with massive orders and then down when they were completed. And then you waited a little while and then up with massive orders and then down when they were completed. So the company's been trying to build out this leasing side of the business to add stability for when you do have the cycles. So that has been working well with Greenbrier. And they are cheap, even though the stock is up near 5-year highs now. So the stock is up 43% year to date, like I said, near the highs of the last 5 years, because things have been looking pretty good on their business side. So they have like 99% lease on the leasing side. So that's the utilization rate, and that's high. So that's what you want to see on the leasing side. Their new railcar backlog is now 26,700 units, worth $3.4 billion. That is for the year. No, that's at the end of the fourth quarter. They just reported fiscal fourth quarter 2024. So they're into now fiscal 2025. They delivered 23,700 units last fiscal year. And the gross margins for the year have now hit their goal, which was to get it up to 16%. And so now they got to have a new goal. Can they get any higher than that? I don't know. They've been trying to cut costs and do whatever it takes to get those gross margins up a bit. We only have one estimate, and it's higher in the last 30 days for both 2024 and 2025, which I guess is now fiscal 2025 and 2026. So 2025 is looking for earnings to be up 4.8% to 520, and then 2025 up 6.7% to 555. That's not like a huge growth rate, but we didn't screen for growth. We screened for value. And the PE is at 12.4 and price to sales of just 0.6. They do have very good free cash flow. They've had good management for many years because they've had to manage these huge cycles and everything. And that takes, a real understanding of their business and being very communicative with the street and shareholders. And so they've always paid a dividend, and right now it is yielding 1.9%. So that's not too shabby either. You get the dividend for your time. Market cap of just $2 billion for Greenbrier is pretty small, but they've just put together a couple of really good years. And that backlog is still big. So we haven't peaked on the cycle yet for the manufacturing and seeing that decline because we are expecting earnings growth, into this fiscal year and next fiscal year. And so no trappiness with this one. And going back to El Pollo Loco, I thought it was kind of obvious no trappiness with that one either when we have double-digit earnings growth expected for next year after double digits this year. So both of these very nice value stocks here with business looking pretty good. So again, if you can get a pullback on Greenbrier because it's hanging out near 5-year highs, then this could be an interesting one to add to your portfolio. And then we're going to wrap it up with Pediatrics Medical Group. I'm sure I'm saying that's wrong, but doing the best I can. I can easily say the ticker, though. It's just M as in Mary D, MD. That's easy to remember. And since 1979, they are a national provider of prenatal, neonatal, and pediatric services. So this is a medical group, as the name entails. Last quarter, they were talking about how they have this new hybrid revenue cycle management structure, which should, quote, benefit the shareholders, unquote. And I feel like this company, maybe it's a little bit harder to actually grow those earnings in this business model that they have. But right now, stock is still cheap, PE of 10.8, price to sales ratio of 0.7. And those earnings, one is higher for the last week for both 2024 and 2025. That's how we're getting the Zacks #1 rank. And that is pushed up the Zacks consensus for the year to $1.35 for this year, $1.47 for next year. So earnings expected to be up 7.1% this year and 9.1% for next year. So this type of company really has to work hard to get that 9.1% earnings growth for next year. They got to keep a lean, mean machine going and keep those costs down and all of that kind of stuff. But apparently that is what they're doing. So there's no trappiness to this one with those earnings expected to be up next year. And so if you're looking to own a medical group, if you can't beat them, join them kind of thing, then this might be the one for you. Pediatrics Medical Group, ticker MD there. And let me just look, what have they done for the year? They're up 54% year to date. So it's had quite a run. Maybe wait for a pullback on this one too. Out of the 5 stocks, the only one that's down on the year now is Dreamfinder Homes. And I wouldn't have guessed that if you would have asked me. Just by telling me these tickers and like what the companies do, I would not have guessed the home builder. So it is intriguing to me. I'm going to go try to find out what's going on at Dreamfinders. Why does the street not like the stock? But that's what we value investors do. We are getting cheap stocks. They're always not soaring and at 5-year highs. In fact, that's usually unusual for a value stock to do. Why are they being sold off? Why are they undervalued? Is there still some more value in them? And in this case, we look to see, are these true values or are they traps? And most of them are looking pretty value-ish, but I guess it's kind of split. We had 3 that are values, 2 that are kind of trappy, not the worst trap I've ever seen. So I'm kind of on the edge with that one. Only partial traps with Dreamfinders and Tenant, but something to keep in mind and to watch closely because you don't want that growth to suddenly slide and go, into the negative or something along those lines. But let me recap the tickers again on these strong buy, cheap stocks. And the first one is Dreamfinder Homes, ticker DFH on that one. Tenet Healthcare on the hospital side, it's ticker THC. Then we had Apoyo Loco, ticker LOCO, LOCO. Greenbrier, which is the freight cars, ticker GBX, and then Podiatrics Medical Group, ticker MD there. And as always, I aim to bring you value stocks every week. We're getting towards the end of the year. I'm going to have some episodes that are like kind of looking at what's happening in value. It's been a good year to be in value stocks. Look at these stocks. They've all been values throughout this year. And again, other than Dreamfinder Homes, which is a surprise to me, the others have outperformed the S&P 500. So it hasn't all been growth stocks this year in 2024. A lot of value have joined in on the rally. And will that be the case next year? Should you be ditching your growth stocks, getting more value stocks in your portfolio, including the banks? What do those look like? We've been waiting, 16 years, 17 years? I don't even know how long now for the banks to finally break out. Hasn't happened yet, but eventually we will be right at some point. And maybe it's time to take a closer look there and see what's going on with those earnings. But I'm going to have all this and more as we head out and close out the year. So be sure to subscribe. Get us on YouTube. We're on the podcast channel over on YouTube because we're all audio, but you can get us there on our podcast channel. Just put in Zacks Podcasts into the search bar and you will find us. And you can just subscribe and you get all the podcasts over there except the Market Edge. But you'll get Nina's great ETF Spotlight. There's John Blank's great podcast. There's a bunch over there. So be sure to subscribe there. You can also obviously get us on Apple, Spotify. We're on Amazon Music. You can get us on SoundCloud with the Market Edge podcast, but put in the Market Edge over there, or maybe it's just Zacks. You can find us over there, but get us somewhere. And I'll be back next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.